reversal bar can be a continuation setup. When a trend is strong, the market often trades below instead of above a bull reversal bar or above instead of below a bear reversal bar. As shown in figure 6.2, on this 5-minute chart of Baidu, Inc. BIDU bar 3 was the third attempt to reverse the market up and it was a strong bull reversal bar. However, instead of moving above it, the market broke out below it. Perhaps there were early longs who entered on the reversal bar before it triggered a buy signal. The next bar did not trade one tick above its height and these overly eager bulls were now trapped. They would exit at one tick below the bull reversal bar, which was where smart traders went short. The opposite happened at the bar 6 bear reversal bar, where traders who shorted before the market traded below the low of the bar were trapped and had to cover on the next bar as it traded above the bear reversal bar. A reversal bar alone is not enough reason to enter, even if it is in an area where a reversal might reasonably take place. Figure 6.3. Signal bars, other types. 115. Figure 6.3. A big trend bar can indicate exhaustion. An unusually large trend bar that forms in a trend that has lasted for 10 or more bars usually means that the market is exhausted and will correct for at least 10 bars, and sometimes it leads to a reversal. In figure 6.3, bar 3 was a huge trend bar that collapsed below the low of the open and through a trend channel line and was followed by a bull inside bar with a shaved top, meaning that buyers were aggressively buying it right into its close. This is a great setup for a long. The large bear trend bar was acting as a sell climax, and the breakout above the bull inside bar was a bull breakout. This is a spike down and then a spike up, which is a reversal, and if you looked at various higher time frame charts, you could find one or more where this bottom was a perfect 2-bar reversal and others where this formed a single reversal bar. Bar 4 Wasabi a reversal bar but a bar 5 short and triber immediately reversed up above the bar 4 high, running the stops on those shorts. It is important to note that shorting below the bar 4 bear reversal bar would not have been a wise decision because the upward momentum was too strong. There were 11 consecutive bull trend bars, so traders should not be shorting below the first bear bar. Buying above the bear reversal bar or above the bar 5 bull outside up bar was a reasonable trade since there were stopped out bears who would wait for more price action before looking to short again. If the bears were not ready to short, the bulls could push the market higher. 116. Price action. Figure 6.3. Deeper discussion of this chart. The day opened with a strong bull trend bar. A gap down in figure 6.3, but it immediately reversed down in a breakout pullback short setup. With the large tails and bodies of the first 2 bars and the small gap down on the open, the odds of more sideways action were high and it would be better to wait and not take the short trade. However, this was followed by a 2-bar reversal signal for a failed breakout setup and a possible low of the day. There was a 4-bar bull spike but no follow through. At some point over the next couple of hours, traders would have taken at least partial profits and may have exited the balance on a break-even stop during the late sell-off, if they did not reverse to short. Bar 3 was also the bottom of a spike and channel bear trend, and the reversal should test the bar 2 start of the channel, which it did. The 5-bar sell-off down to bar 1 was the spike, and the channel down began at the pullback to bar 2. The sell-off down to bar 3 was climactic because it had about a dozen bars with lows and highs below those of the prior bar. The actual number is not important. What is important is that there were many bars, and the more there are, the more unsustainable and therefore climactic the behavior is. A large bear trend bar like bar 3 after a strong bear trend is a sell climax. This usually leads to a 2-legged sideways to up correction, and less often to a trend reversal like the one that developed here. The failed bar 4 reversal bar was a failed low 2 buy setup. The low 2 trapped NAIV traders who sold under the reversal bar but failed to wait for a prior demonstration of bearish strength. You should not sell in a strong bull trend if the market is in a tight channel where there has not been a prior bull trend line break. The 4-bar spike up to the 705 bar could have been followed by a channel up. The spike down to bar 1, however, created the possibility that there might be a channel down instead, which was the case. It was appropriate to buy the pullback that ended around 8:45, expecting the spike up, and equally appropriate to reverse to short below the bear inside bar that followed bar 2. Note that none of the dojis before and after bar 1 are good signal bars, because they are in the middle of the day's range and next to average. The swing high that occurred 5 bars before bar 1 formed a 3-bar reversal, which would look like a 15-minute reversal bar with a 1-tick tall bull body on the 15-minute chart, since the third bar closed at the same time as the 15-minute bar. Figure 6.4. Signal bars, other types. 117. Note that 15-minute reversals can be seen on a 5-minute chart. In Figure 6.4, the 15-minute chart on the left had several reversal bars and the corresponding 3-bar patterns were within the boxes on the 5-minute chart on the right. In general, a 15-minute reversal is more likely to result in a longer move than a 5-minute reversal is. When you are looking to take a 5-minute trade, if you see 3-bar combinations that also create 15-minute reversals, you usually can feel more confident about your trade. In general, it is a good idea to look at any trend bar that is followed within the next 10 bars or so by an opposite trend bar with a close near the open of the first bar as a reversal. The reversal will be a 2-bar reversal on some higher time frame chart, and a reversal bar on an even higher time frame chart. Deeper discussion of this chart. The market broke below the moving average in Figure 6.4, and the breakout failed and led to a trend from the open bull trend. Bar 3 was a moving average gap bar in a strong trend, and the move down to bar 3 broke the bull trend line. A moving average gap bar often leads to the final leg of the trend before a larger correction. Bar 4 was a 2-bar reversal short setup at the higher high. 118. Bar patterns on the 5-minute chart do not create good reversals on the 15-minute chart, but they still lead to acceptable reversals. In Figure 6.5, the 5-minute chart on the right had a couple of 3-bar patterns that looked like they should form perfect 15-minute 3-bar reversals. However, since the third bar in both cases closed at 25 minutes after the hour instead of at 30 minutes after the hour, when the 15-minute bar closed, the 15-minute pattern did not show the same strength. Traders could trade the 5-minute pattern if it was a perfect 15-minute reversal and buy at 1 tick above the high of the 3 bars, or earlier if there was an earlier 5-minute entry. For example, in the second example 1 5-minute chart, the second and third bars formed a 2-bar reversal, so it would be acceptable to enter at 1 tick above the 2-bar reversal instead of 2 ticks higher, above the top of the 3 bars. In general, traders should not spend time looking for 3-bar reversals, because they occur only a couple of times a day and you should not risk missing other more common setups. Bar 2 was the first Barafatu bar reversal, and you called fin summer time frame where the 3 large bear trend bars that led to the bottom and the 2 large trend bars that followed bar 2 comprised a 2-bar reversal, like the 15-minute chart on the left. You could also find a chart where those bars created a perfect single reversal bar. Because of this, all reversal setups are closely related. Don't be too. Figure 6.5. Signal bars, other types. 119. The goal. You are trying to see when the market is trying to reverse and then look for some way to get in once you believe the reversal will likely have follow through. Deeper discussion of this chart. The market broke below yesterday's low with a small gap in Figure 6.5, and the first bar was a failed breakout by setup for a possible trend from the open bull trend. When the reversal is within a steep bear channel like this, it is better to wait for a pullback after the reversal up before buying. There was a higher low a few bars later, but the bars were sideways and had big tails, so bulls should wait for more strength. Instead, there was a low too short that was also a breakout pullback short, but most traders prefer to wait for the breakout of the entire opening range when the opening range is a small trading range that is less than about a third of an average day's range. The large bear trend bar that broke out below the low of the opening range shows that most traders waited for that breakout before going short. Bar 2 was a 2-bar reversal for an opening reversal long. It followed a 1-bar final F lag, and there was earlier buying strength in the strong first bar of the day. 120. Price action. Bar something triacinetic beyond both. It Two-bar reversal is a setup composed of two bars antitriacinetic beyond both. In figure 6.6, even though bar 5 was a bear trend bar, its low was one tick above the low of the bar before it. When a reversal bar almost entirely overlaps the bar before it, it should be considered to be a two-bar reversal setup. Here, for example, the safest short entry was below the lower of bar 5 or the bar before it. The market fell one tick below bar 5, but it formed a double bottom with the low of the bar before it. Traders who thought that it was safe to short below a large bear bar were stopped out with a loss. Bar 3 was a similar situation, and if a trader was thinking of shorting, it would be safer to short below the low of the bar before it and not just below the bar 3. In any case, this was a risky short since the market had been trending up strongly for 9 bars. It would be much better to not short and instead look to buy a pullback, like above the bar 4 2-bar reversal. Bar 1 was the second bar of a 2-bar buy reversal where the second bar was above the high of the first bar. The entry is above the high of that second bar. Bar 2 was a 2-bar reversal where the highs of both bars were the same. Figure 6.6. Signal bars, other types. 121. Deeper discussion of this chart. There was a large gap down and a bull trend bar in figure 6.6. The market then formed a 2-bar reversal down that did not trigger a short and instead became a 2-bar reversal up. The long above bar 1 had good follow through 2 bars later. Since this was a possible trend from the open bull trend and there were signs of buying strength, traders should rely on their initial stop below the low of the day until after the higher low. Once the market turned up from the higher low with a strong bull trend bar, they could move their stop up to below the higher low and hold long into the close. 122. Always be ready for a reversal in the first hour or so. Goldman Sachs Group GS was in a bear trend yesterday and had a strong rally off the open today, so traders were looking for a pullback to a lower low or higher low and a possible trend reversal. As shown in figure 6.7, there was a lower low at bar 1, which was tested by bar 3 and they created a double bottom. This was followed by a higher low at bar 5, and bulls were looking for a buy setup for a possible new bull trend. Bar 5 was an inside bar and the bar after it was inside of bar 5, with its low above the low of bar 5 and its high below the high of bar 5. This is an E setup, and traders would buy on a stop at one tick above the second bar. Bar 6 was a second E setup since it was an inside bar and the bar before it was also an inside bar. Deeper discussion of this chart. There was a tricky open in figure 6.7, and when in doubt, stay out. The market broke above the trading range of the final couple of hours of yesterday, but the breakout failed on the third bar. The market then broke out below the trading range and that breakout failed and reversed up at bar 1. Bar 3 was an acceptable double bottom long setup, but traders who waited could buy the double bottom pullback above bar 6. This was a double bottom pullback buy setup. Double bottom pullbacks have a pullback that typically extends more than 50% and often almost the entire way. Figure 6.7. Signal bars, other types. 123. To the double bottom. This double bottom was exact to the tick. The higher low often forms a rounded bottom, and traditional stock traders would describe it as an area of accumulation. The name is irrelevant. What is important is that the market failed to put in a lower low on this second attempt down. Bar 3 was the first, so if it can't go down, the bears will step aside and the market will probe up in search of sellers willing to sell at a higher price. Instead of finding sellers, the market found buyers willing to buy at the higher price. Bar 7 set up a third entry on the back-to-back, opposite failures. The market failed on the upside breakout above bar 6 and then failed on the downside on the next bar, meaning that both the bulls and bears were trapped. Bar 7 became just a pullback from the breakout above bar 6 and is therefore a breakout pullback long setup. Bar 4 was a double top bear flag short setup. The rally on the open was followed by a lower high at bar 2, which was tested by bar 4, creating a double top. Since the double top was below the high of the open, there is a possible bear trend and any pullback in a bear trend should be thought of as a bear flag. 124. Price action. Figure 6. Sometimes the bars are so tiny that they appear to be insignificant, but they still can be telling you something that is very important. In figure 6.8, the bar 2 signal bar was at any bar 11 cents in a $185 stock, but if you look at a line chart of the closes, the small higher low was clear at point 2. Bar 2 was the second half of a reversal setup, and the large bear trend bar that formed 3 bars before bar 1 was the start of the down part of the reversal. You could find some higher time frame chart where this collection of 10 bars formed a 2-bar reversal. Figure 6.8. Signal bars, other types. 125. Deeper discussion of this chart. The day opened on the high tick in figure 6.8 and had a 2-bar spike down as it broke out of a 2-bar bear flag from yesterday's close. The market tried to reverse up on the 4th bar, but there was no long entry since it was an outside up bar without follow-through. The shorts would hold with a stop above the signal bar or maybe above the outside up bar. The next bar was a bear inside bar that set up a low 2 short entry in a trend from the open bear trend. The bull reversal bar 3 bars before bar 2 was a riskier entry since the market had been in a tight bear channel for the 7 prior bars. It is safer to wait for the breakout from the channel and then buy the breakout pullback. This pullback was more of a sideways pause and it ended with the bar 2 higher low buy signal. Second entries in general are more reliable. It was very close to being an E pattern, which often leads to reversals at the ends of swings. Bar 1 was not a good setup for the reversal up from the final flag breakout because the signal bar was doji. Instead, you should wait for a bull trend bar for a signal barween bottom picking in a strong bear trend. Also, the prior 4 bars were bear trend bars, so there was too much downward momentum to be buying the first attempt to reverse, especially when the signal bar is a doji, which does not represent strong buying. 126. Price. Because an E pattern always represents a clear reversal setup on a smaller time frame chart, you never have to check that chart to confirm it. In figure 6.9, on the 5-minute chart on the right, there were 2 E patterns. The first is an E. These often are clearer reversal patterns on smaller time frame charts, like the 1-minute chart on the left. The bar 1E on the 5-minute chart was a higher low that was tested repeatedly on the 1-minute chart. The bar 2E on the 5-minute chart was a higher low after a higher low, so the market was making trending higher lows, which is a component of a bull trend. In both cases, the bull trend bar at the end of the E pattern was a great setup for a long entry. Even though small bars have less directional significance, it is always better to have the final one be a trend bar in the direction of your intended entry. Bar 2 on the 5-minute chart formed a reversal with the bear trend bar that formed 2 bars earlier. Deeper discussion of this chart. The bar 1 setup on the 1-minute chart in figure 6.9 was a double bottom pullback buy pattern, and the bar 2 setup was a failed low 2. Figure 6.10. Signal bars. Figure 6.102 bar double bottoms and tops. Double bottoms and tops can be as small as 2 consecutive bars and still be important. In figure 6.10, bar 1 was a micro double bottom bear flag setup, since it is a bear trend bar immediately followed by a bull trend bar in a bear spike and they have identical lows. Sell at 1 tick below its low. You could also sell below the low of the 1-bar pullback on the next bar, giving you an earlier entry. Bar 2 was another example. Bar 3 was a micro double top entry bar for a long trade, since the bear trend bar is a 1-bar bull flag in a bull spike, a high 1-buy setup in a bull spike. It is also a micro double bottom and a 2-bar reversal with the bar before it. Traders could therefore also buy above the high of bar 3, although this is a riskier entry since it is 4 ticks worth. Also, buying above a large bar after a breakout of 3 overlapping bars is risky because those 3 bars might be the start of a trading range. Deeper discussion of this chart. The first bar of the day in figure 6.10 broke out below yesterday's low and the breakout failed. Since the market was still within the trading range from the final hour of yesterday. 128. Price action. Figure 6.10. And the 2-bar reversal up on the open had large bars. This would force traders to buy at the top of a trading range that had many bars with large tails. Instead, traders should wait. The move up to the moving average was a bear flag and it broke out at 7:15 a.m. Pacific Standard Time, but the breakout failed and reversed up on the next bar in a 2-bar reversal, which was a reasonable buy. At 8:50 a.m. there was a double bottom pullback long setup. Figure 6.11 a strong 2-bar reversal. Although it is usually better to not buy the first reversal attempt in a strong bear trend, a strong 2-bar reversal can be a reliable buy setup after a sell climax. As shown in figure 6.11, Lehman Brothers Holdings (LA) had a 2-bar reversal bottom on a test of the bear trend channel line and after consecutive sell climaxes. The sell-off was climactic because it was unsustainable behavior. 16 of the prior 17 bars each had a high that was below the high of the bar before. Also, there were 3 occurrences of a large bear trend bar that followed a series of smaller bear trend bars. A climax is usually followed by a 2-legged correction that lasts for many bars, at least an hour on a 5-minute chart. Bar 1 was the first bar of a 2-bar reversal. It is usually risky to buy the first reversal in a strong bear trend, but after several signs of climactic behavior and a very strong 2-bar reversal, this was a reasonable buy setup. Bar 1 was another large bear trend bar and therefore another sell climax, and the second bar was a strong bull trend bar. It was large and it opened on its low and closed on its high. Deeper discussion of this chart. The market in figure 6.11 opened with a breakout of a bear flag over the last 90 minutes of yesterday and it tested yesterday's low. The third bar tested the moving average and 130. Price action. Figure 6.11. The next bar set up a low too short for a possible trend from the open bear and breakout pullback short. Many traders waited for the breakout below the first bar of the day to go short, and this resulted in a bear trend bar that became the first bar of a 3-bar bear spike. Traders could also get short below the bear flag that followed. Bar 1 had a big range and followed a strong bear leg, and it was therefore a sell climax. There was another large bear trend bar 4 bars earlier and it, too, was a sell climax. When a trend is particularly strong, it often will not correct until after a second sell climax, and rarely after a third. The small inside bar that formed 2 bars before bar 1 turned into a 1-bar F-inal flag. There were 3 large consecutive bear trend bars with very little overlap off the open, and they constitute a spike down. A strong spike down is commonly followed by a bear channel and then a pullback and sometimes a reversal. That initial spike down was followed by a sideways low 2 and then even stronger selling. Even though this follow-through selling was almost vertical, it should be thought of as the bear channel that followed the initial spike down. That low 2 is a type of final flag, even though the market fell far before trying to pull back. Spike and climax bears, a type of spike and channel bear trend, usually test around the start of the channel within a day or 2, but when the selling is this strong, they may not, and a higher time frame pattern might be controlling the market. For example, the entire sell-off down to bar 1 might be a large spike on the 60-minute chart and the trading range that followed might become the pullback that leads to a large bear channel move down to much lower prices. Figure 6.12. Signal bars, other types. 131. Figure 6.122 bar attempt to reverse a strong bull channel can be a reliable short if it is at the end of a buy climax and the 2-bar reversal is strong. In figure 6.12, bar 4 was a large 2-bar reversal top on a break above yesterday's high and a bull trend channel line, and after the breakout of a small flag bar 3. When 2 bars overlap so much, the chances of a profitable trade are greater if you short below the lower of the 2 bars and not below the other bar 4 in this case. Also, the second bar had a large bear body, and when a bull trend is strong, you should short only below a strong bear bar and never below a strong bull bar. Bar 1 and the bear bar before it did not provide a good 2-bar reversal buy setup because there was too much downward momentum in those 2 large bear trend bars on their breakout from the lower high. The bars barely overlap one another and they have small tails. This was immediately followed by another 2-bar reversal buy setup. Back-to-back patterns happen occasionally, but 4 overlapping bars after a spike down there is a bear flag and you should not buy at the top of a trading range in a bear trend, especially just below the moving average. 2-bar reversals are counter-trend signals only if there is a reason to expect a reversal. 132. Price action. Figure Bar 2 is an acceptable entry bar for a short based on the 2-bar reversal top created by the prior tubers. It was reversing for small correction up to the moving average. However, whenever there is a 2-bar reversal sell setup just below the moving average and the bars are relatively large and overlap one or more other bars, you usually can buy at or below the low of the signal bar for a long scalp. This is a small trading range and it is usually better to buy at the bottom of a small trading range. Bar 4 was the first bar of a 2-bar reversal. Deeper discussion of this chart. The 4 2-bar reversal in figure 6.12 followed a small final flag at bar 3, and it was the third push-up after the bull spike that began at 9:10 a.m. Spike and channel patterns often correct after 3 pushes up. The spike is the first push and then there are often 2 more spikes followed by a correction that usually tests to around the bottom of the channel. The first bar of today was a breakout below the double bottom bull flag of the final 90 minutes of yesterday. Traders could have shorted below the double bottom on a stop or below the E breakout pullback setup 3 bars later. There was a large 2-legged move down from yesterday's high that ended in a triple bottom on today's open. There was a second chance to go long on the higher low at 9:05 a.m. Pacific Standard Time, after the initial strong leg up that tested the high of the open. This was also a breakout pullback by setup even though the market had not yet broken out above the high of the open. Bar 1 was an up bar, and it was followed by a down bar and then a second up bar that tested the moving average. This is a small 2-legged correction to the moving average and therefore a low 2 short setup. There were also trapped bulls who bought above the back-to-back 2-bar reversal bottom attempts, and once the low 2 triggered, they would exit their longs with a loss. Their selling adds to the selling of the new bears and increases the chance of success. Also, since they just lost, they will be hesitant to buy, and the losses of buyers increase the chance of a successful short scalp. A series of overlapping bars is a tight trading range, which is a magnet, and breakouts often fail and the market is drawn back into the tight trading range. This is because both bulls and bears feel that there is good value in that range. When the market drifts toward the bottom of the range, the bulls feel that there is even better value and they buy more aggressively. The bears prefer to short in the middle or top of the range. Their absence at the bottom of the range and the increased buying by the bulls lifts the market back up. The opposite happens at the top of the range, where bears become more aggressive and the buyers stop buying and wait for slightly lower prices. The entire figure 6.12 signal bars, other types. 133. Process is amplified on a breakout. Here, the bears were able to overwhelm the buyers and break the market to the downside. However, instead of finding new sellers down there who could push the market down further, the buyers saw these lower prices as an even better value than that in the tight trading range. The result was that the market was pulled back into the range. The market later tried to break out of the top and again was pulled back into the range. However, there will always be an successful breakout eventually. 106.13. A bar with no tail at either end in a strong trend is a sign of strength, and traders should enter with trend on its breakout. In figure 6.13, bar 8 was a bear bar in a strong bear trend, and it had no tail at both its high and its low, indicating severe selling pressure. They sold it from start to finish. It was likely that there would be more selling to come. Traders have to be fast in placing their sell stop orders because the market is moving fast. Alternatively, they can just short at the market or on a 1 or 2 tick bounce using a limit order. The bar after bar 10 had a shaved top in a bear trend, but since the market was not in free fall at this point, that alone was not enough reason for a short. The bar after bar 16 was a bull trend bar with a shaved top and bottom, but it was not in a bull trend and therefore it does not function as a buy setup based solely on the absence of tails. The bar after bar 17 and the bar before bar 20 were not shaved bar sell setups because they were not in a free fall bear trend. There were many 2-bar reversal setups on this chart, as there are on all charts. Deeper discussion of this chart. There was a quiet open in figure 6.13 that continued the tight trading range of the close of yesterday. Bar 8 was a 2-bar breakout and traders could have shorted on the close. Figure 6.13. Signal bars, other types. 135. because of a likely trend from the open bear trend, or below bar 10, the first pause, or on the bar 13 double top bear flag test of the moving average. Bar 11 was the second bar of a 2-bar reversal, and the market might have been trying to turn up after the sell climaxes. The next bar was a doji inside bar and a low 1 short setup. However, when there is a bear flag where the signal bar mostly overlaps with the 2 prior bars and the market might be in a trading range, the odds are high that the short will fail and will become a bear trap. Do not take these short signals. The 3-bar rally from bar 12 led to a 20-gap bar short, but since the upward momentum was strong, it was better to wait for a second signal, which occurred at bar 13. Bar 19 was a moving average gap bar short, and it led to a new low of the day. It was also a failed breakout above the bars 15 and 17 swing highs and a test of the top of the trading range. It is common for a trend day to have a strong countertrend move between 11 a.m. and noon PST, trapping traders into the wrong direction as it did here. It is important to realize this so that you will be mentally prepared to take the with trend trade, which was a short here. Since the bar before bar 10 was a large range bar in a trend that had gone on for a while, it is a sell climax and the market might try to correct sideways to up soon. The first pause in a strong trend is usually a successful short scalp, even in a strong bear trend, but it might become a final flag and lead to a correction up. The breakout below its low may reverse up within a bar or two. Whenever there is a strong spike down, it is usually followed by a measured move down based on some aspect of the spike, usually the distance from the open or high of the first bar to the close or low of the last bar of the spike. The low of the day was a perfect measured move down from the open of the first bar to the close of the final bar. Traders should continue to hold short at least until the market reaches the general area of these targets. Bar 16 was a large bull inside bar reversing up from a new low of the day, and the market was now in a trading range. It was also a high 2 in a trading range and therefore an acceptable long setup. The high 1 formed 2 bars earlier. The 2-bar spike down into the close of yesterday led to the bear channel that ended on the bar before bar 11 today. However, the entire channel was steep enough to likely function as a spike on either the 15 or 60-minute chart, and the market might be in the process of channeling down into the close of the day. The bar 21 strong bear trend bar or the bar before bar 20 might have served as a small spike down that led to the bear channel into the close of the day. 136. Price action. Apple AAPL demonstrated many common signal bars on the 5-minute chart shown in figure 6.14. Even though bar 1 was a hammer doji bar at the bottom of a swing down, and it would make many candle worshippers want to buy, especially since it was a double bottom with the first bar of the day, this was a bad setup for price action traders. It was the third overlapping doji, meaning that the market traded both up and down in all 3 bars. This was an area of 2-sided trading and therefore a trading range, and whenever there is a trading range just below the moving average, the odds favor a downside breakout. There are always sellers on any test of the moving average from below, and there was not enough room between the high of the bar and the moving average to make even a scalper's profit. If you were to buy above bar 1, you would have to pay attention to the size of the bars, all of which had relatively large ranges. This increases the risk of the trade because your protective stop location should be in part determined by the size of the current bars. If you wanted to keep your risk the same on all of your trades, you would have to trade fewer shares. Bar 2 was a much better reversal bar setup because it had a decent size bull body and it was the second attempt to reverse up from below yesterday's low end. Figure 6.14. Signal bars, other types. 137. From bar 1 was the first attempt. The bull bodies of the first 2 bars of the day showed some prior bull strength. The tail at the top showed some weakness, but this was erased by the trend bars that followed it. Bar 2 was the second barafatu bar reversal and the middle of a larger 2-bar reversal on some higher time frame chart. You can find a chart where the bar before or after formed a 2-bar reversal, and you could find an even higher time frame chart where the 2 bars before and the 2 bars after formed a 2-bar reversal. As with all 2-bar reversals, you can find an even higher time frame chart where the 5 bars formed a single bull reversal bar. Bar 3 was an outside up bar, an outside bar with a bull body after a pause bar, which followed the breakout to a new high of the day, and was an entry bar for the purchase above the high of the small bar. Outside bars in new trends often trap traders out of great trades because they happen so quickly. Many traders don't have enough time to reverse their perspective fast enough from bearish to bullish, and then they have to chase the market up. The bar before bar 3 was a doji, so it was not a strong setup for a short, even though the market might reverse down after a breakout to a new high of the day. Only scalpers and weak shorts would bear shorting below its low because of the signs of bull strength that were accumulating. The bar before that doji had the largest bull body of the day and closed on its high, and it was also the third consecutive up bar. All three bars had decent sized bodies, and the second and third did not overlap more than half of the prior bar. It was likely that traders were aggressively looking to buy any pullback and had limit orders to buy both below the low and above the high of the doji, and the buying was so strong that both sets of buy orders were filled in one bar. Bar 4 was a bear doji at a new high, but the upward momentum was so strong and the reversal bar was so weak that a short could be considered only on a second entry. This was the first bear body after 7 consecutive bull bars, and the market rarely reverses very far on the first attempt, especially when the signal bar has a close in the middle instead of at its low. The bears were not even strong enough to close the bar on its low, so they will unlikely be able to push the market down very far before the bulls overwhelm them again. Bar 5 was another outside up bar that tested the moving average and the breakout from the opening range, and it was the end of first pullback in a strong up move. Bar 6 was a bear reversal bar and a second entry short setup. The first was 2 bars earlier after taking out the bar 4 swing high and yesterday's high. Since the bears had enough strength to test the moving average with bar 5 and the bull trend is even more overdone, the bears should be able to correct to the moving average or even below it this time. As a trend wears on, the bulls typically will want deeper pullbacks before looking to buy again. Bar 7 was an entry bar on an E-short setup at a time when you were expecting a test of the moving average. Both E-bars had bear bodies, which increases the 138. Price action. Figure 6.14. Chance of success for a short trade. Although a bull body on a bear entry bar is not good and the bar after it traded above it, the market did not trade above either of the E-bars where the protective stop would be. If you are going to take a trade in a tight trading range, you have to give it a little room. That entry bar became a small bull reversal bar, but small reversal bars are rarely good, and when one forms in a tight trading range, it should not be looked at as a reversal bar because there is nothing to reverse. The E breakout reversed back up a couple of bars later, which is expected when an E is in the middle of the day's range. Also, the market completed its goals of 2 legs down and a penetration of the moving average. Bar 8 was a doji bar at close to a double top in what was now a trading range. Doji bars are never good signal bars for shorts in strong bulls, but they are acceptable signal bars for shorts in trading ranges depending on the context. Since the market was testing the top of the range, it was an acceptable signal bar for a short since the market might test the bottom of the range. Bar 9 was a 2 bar reversal after an using low and test of the bar 5 low. The entry was above the high of the higher of the 2 bars, which would be above bar 9. However, this is risky because there will always be shorts at the moving average when the market tests it from below. Also, the 2 bars are large, forcing buyers to come in too high above the low of a down leg. When the risk is greater, it is better to not take the trade and to wait for a strong setup. Bar 10 was a 2 bar reversal following 4 bear trend bars with good size bodies, small tails, and very little overlap, and therefore a good short setup in a strong bear trend. Bar 11 was a bull reversal bar after a 3rd push down, and it was an attempt to hold above the low of the day. The bear trend had gone on for a long time and there were many pullbacks along the way, so the odds were high for a test of the moving average. Since it is counter-trend, you have to be willing to allow for pullbacks in the move up to the moving average, so do not tighten your stop too soon. Deeper discussion of this chart. The market broke below the moving average in the pen and figure 6.14, but her breakout failed with a strong bull reversal bar. The second bar had a bull body, but it also had prominent tails and it failed to get above the moving average. There was also no follow-through buying on the 3rd bar, which also tested the moving average and failed to get above it. Bulls should have considered exiting their longs and waiting since the market was now in a small tight trading range below the moving average and the bars were large with tails. A tight trading range below the moving average usually breaks out to the downside, but there was no reliable short setup. Instead, traders should wait for a better setup. Bar 2 was a strong bull reversal bar that set up along of the failed breakout of that tight trading range, which became a final flag. Figure 6.14. Signal bars, other types. 139. 1. Market broke above the opening high, a measured move up was likely. Bar 2 was also a bear micro wedge that overshot the trend channel line that could be drawn across the bottoms of the prior 3 bars. Notice how there is a tail at the bottom of the bar that followed bar 1. That means the buyers came in around the low of the bar. The bears were hoping to find sellers on the breakout below the low of the bar and for the close to be well below the low of the bar, but instead there were some buyers. This happened on the next bar as well, and even more so with bar 2. The bears were finally able to drive the price even further below the low of the prior bar, but the bulls became especially aggressive and reversed the market and closed the bar above its open and near the top of the bar. Although micro wedges by themselves don't usually lead to major reversals, the other factors at work here created the low of the day. Bar 2 along with the bar before it and the bar after it also created a 3-bar reversal and a 15-minute reversal bar, because the bar before it would have the same open as the 15-minute bar, the bar after it would have the same close as the 15-minute bar, and that close is above the open. The next bar would then trigger a 15-minute long entry. The move down from bars 4 to 5 had several overlapping bars and could be a final F flag. Bar 5 and the bar that followed it both had very large bodies and small tails and therefore formed a 2-bar biclimax. When a climax occurs after a trend has been going on for many bars, the odds of a 2-legged sideways to down correction lasting at least 10 bars increase. The next bar was a bear inside bar after a biclimax and might become a 1-bar final flag. Bar 6 was the second leg up from the bar 5 first pullback and from the bar 2 low, and second legs are often reversals. Also, it was a low 4 and a wedge, with the 3 pushes being bar 4, the bar after bar 5, and bar 6. It was additionally a larger wedge, with the 3 pushes being the 3rd bar of the day, bar 4, and bar 6. With this many factors operating, a trader should expect at least 2 legs down. It also followed 2 biclimaxes, the first being the 2-bar climax of bar 5 and the next bar, and the second being the bar before bar 6. A second consecutive biclimax usually results in at least a 2-legged correction that penetrates the moving average and lasts at least an hour. The 2-legged pullback that followed the bar 6 short penetrated the moving average and ended with a moving average gap bar. Since it formed in a strong trend, a test of the trend's high was likely. It was also a wedge bull flag by setup, with the first push down being the bar before bar 6 and the second push down being the 3rd bar after bar 6. A moving average gap bar often leads to the final leg of the trend before the market has a larger pullback and even a reversal. Bar 8 was a lower high or double top after a moving average gap bar, which always breaks the trend line and therefore a possible trend reversal. There is a good risk-reward setup for a swing down, and shorts should swing part of their position. It also formed a 1-bar final flag reversal and a micro double top reversal with the tails at the top of either of the 2 bars before it. 140. Price action. Figure 6.14. Bar 9 was a wedge bull flag with the 3 pushes down from bar 8, but because the sell-off was in a relatively tight bear channel and the market might have reversed into a bear trend, it is better to wait to see if there will be an acceptable breakout pullback by setup. 5 bars later, there was an outside up bar, but that is not an acceptable long entry in either a trading range or a bear trend, and therefore buyers would have to wait some more. Bar 9 was also an attempt to form a double bottom bull flag with bar 5, at a price level where the market found buyers earlier in the day. Finally, it was the end of a large 2-legged correction from the bar 6 high and therefore a high 2 long and probably a clear high 2 long on a higher time frame chart, like the 15-minute chart. Bar 10 was a breakout pullback from the breakout below the bar 9 wedge bull flag low and the failed high 2, and it followed a breakout below the double top bear flag that formed after bar 9. The 4-bar breakout was a spike down, and the market bounced back up to test the bar 10 top of the channel by the close. There was a double top bear F-lag short setup with the high of bar 10 and the bar that formed 4 bars later. All breakouts are spikes and climaxes, and there was a second sell climax 2 bars before bar 11. As a consecutive sell climax usually leads to at least a 2-legged pullback. A breakout spike often leads to a measured move down. Take the number of ticks between the open of the first of the 4 bars and the close of the 4th bear bar and project down from the top of the first pullback the high of bar 10. Bar 11 was similar in appearance to bar 1, which earlier found buyers in this price area and they may be willing to buy again. Since there has not yet been a break of the bear trend line, the odds of a trading range are greater than the odds of a significant reversal. The move down from bar 6 was in a channel, and a bear channel should be thought of as a bull flag, so there might be a strong move up before long. Also, the entire move down from bar 6 is a complex 2-legged move with the second leg down beginning at bar 8. It might be a simple 2-legged correction on a higher time frame chart, like the 60-minute chart. Bar 11 was a micro double bottom reversal with the tail of the bull doji bar that preceded it. Figure 6.15. Signal bars. Other type. The bear spike can be a 1-bar bear flag. In figure 6.15, bar 8 was a break below a bull reversal bar, failed reversal bar in a strong bear trend and is a great short because the early bulls who bought will be trapped and forced to sell below its low. Bars 8 through 14 created a 2-bar reversal on a higher time frame chart and a single reversal bar on an even higher time frame chart. Bars 9 and 10 formed a small double bottom and bar 11 was the entry bar for the long, but a doji is not a good signal bar for a counter-trend trade against a strong trend. There were no prior bull pullbacks in the sharp sell-off, and since the first pullback in a strong trend usually fails, smart traders expected this bottom to fail. They placed sell stop orders to go short exactly where the losing longs would sell out of their positions, which was 1 tick below bar 11. A doji is a 1-bar trading ranges and bars 9 and 10 created a pair of large dojis with a small doji in between. These 3 bars formed a small sideways trading range in a strong bear trend, which is a bear flag, so a downside breakout was likely. Since bar 11 was the second attempt to rally, the first attempt was 2 bars earlier but it could not even get above the bull doji just before it. The longs would almost certainly exit below bar 11 and not look to buy again until the market moved down for a bar or 2. As these longs sold their positions, their selling added to the selling pressure from the smart traders who expected this weak bottom to fail. And 142. Price action. Figure 6.15. Therefore shorted below bar 11. The only traders willing to buy just bought and lost, so the market became briefly one-sided and destined to fall. Deeper discussion of this chart. Bar 11 formed a micro double bottom with the tail at the bottom of the large bear bar 2 bars earlier. The bottoms do not have to be exactly at the same price. Since the market was in a bear spike, selling the breakout below the bar 7 double bottom low was a reasonable short. This is different from the bar 18 micro double bottom with the tail of the doji bar 2 bars earlier, which was in a pullback from a 4 bars bull spike and not in a bear spike. It was reasonable to buy above bar 18. Most minor bull reversals come from some type of micro double bottom, as discussed in book 3 in the chapter on reversals, but not good to short below it. Bar 11 formed a micro double top with the high of the bar 2 bars earlier, and became a low 2 bear flag sell signal bar. Bar 15 strongly broke above the bear trend line in figure 6.15, and the gap down opening to bar 16 was a higher low buy stop for an expected second leg up. The market broke below the moving average and below the double bottom bull flag of the final hour of yesterday and the breakout failed. Bar 18 was a breakout pullback long for the breakout of the bull flag from bar 15 to bar 16. Bar 6 and the next bar were large bear trend bars that broke out below the bars 2 and 4 double bottom. The tails were small and the bodies were large, and more selling was likely. Every large bear breakout is a sell climax, but that does not mean that the market will reverse. This breakout looked strong and the bulls could generate only a 2-bar pause after the sell climax before they were overwhelmed again by the bears. A breakout is not only a climax but a spike as well, and when the breakout is strong like this, it is usually followed by a channel down before a tradable bottom develops. Bears will be aggressively shorting every pause and every little pullback until a possible bottom forms. The bottom will usually be at some measured move target, and the first one to consider is a measured move down from the top to the bottom of the trading range before the breakout. Next, look at the open of the breakout bar to the close or low of the final strong bear trend bar of the breakout, which might be the bar before bar 7 or the bar before that. It turns out that the bear trend bottomed at a measured move using a projection down from the top of the spike to the low of the third and final bear bar of the spike. You should also look for other possible measured move projections as well, because if the market tries to reverse within a couple of ticks of one of these magnets, it should increase your confidence to take the trade. However, you cannot take the countertrend trade on a measured move alone since most fail and you have to keep looking at others. The odds of success are too small. However, if there are other reasons to take the trade, like a trend channel line overshoot and reversal or a final flag reversal, the odds of success increase considerably. Figure 6.15. Signal bars, other types. 143. After a strong spike down, the most likely follow-up will be some type of channel down and eventually a test up to the top of the channel. Traders would keep shorting all the way down the channel and then buy at the bottom for the pullback to the top of the channel. Bar 8 and the bar after it were large bear trend bars with little overlap and therefore constituted a second sell climax. Although a second sell climax usually leads to two legs sideways to up and lasts at least 10 bars, the move down to bar 9 was so steep that buyers were unwilling to buy and sellers were still willing to sell more. Bar 11 was the end of a 4-bar barbed wire pattern, and barbed wire after a long trend often becomes a final flag, which was the case here. Traders were expecting any breakout below the small tight trading range to soon fail and the market to be pulled back into the range. Because of this, they would likely only scalp the short below bar 11 instead of holding it for a swing down. The 2 bars after bar 11 were again large bear trend bars and formed a third spike, which is always also both a breakout of something here, barbed wire, and therefore a potential final flag and a climax. A third consecutive sell climax is fairly unusual and the odds were therefore high that there would be at least a two-legged sideways to up correction lasting at least 10 bars. This is even more likely after a final flag breakout and a measured move. Even though the bar 12 signal bar at the low had a bear body, its close was above its midpoint, so the buyers showed some strength. It was also the third push down after the spike breakout. Bars 7 and 9 were the first two, and the channels that follow spikes often end with a third push. In the context of a final flag, a third consecutive sell climax, a wedge bottom, and a measured move, it was a good setup for a rally. The first objectives were tests of the top of the barbed wire around the bar 11 high and a test of the moving average. Another objective was a two-legged move sideways to up lasting about 10 bars or about an hour. The final objective was a test of the top of the channel after the initial spike, and that was the top of the bar 7 bull bar. Although the move up to bar 15 had 2 legs, it was mostly contained in a channel and therefore more likely to be a complex first leg in a larger two-legged pattern, which it was. The second leg up began on the bar 16 open of the following day. 144. Price action. Figure 6.16. Many good setups every day on every chart, and the more experience you have in spotting them as they form, the better chance you have of being able to profit from them. In figure 6.16, bar 1 was a 2-bar reversal buy setup after taking out the low of the open, and it was a higher low compared to yesterday's low. The small bear reversal bar before bar 2 tested the moving average and was an attempt to make the 2-bar reversal fail. It failed and became just a pullback from the breakout above bar 1. When the market is trying to go up, it is good to buy above pullbacks. Bar 3 was a bear inside bar after an attempt to break above a bull trend channel line and yesterday's high. This set up a short because if the market traded below its low, traders would think that the breakout had failed and there should be a pullback. Bar 4 was Doji bar after 2 the dojis, and a bar with that anybody and a micro wedge top made of dojis is rarely a reliable setup. The overlapping dojis represent two-sided trading and therefore uncertainty. However, the 3 tails on the tops of the bars were a sign of building selling pressure. A second entry setup came 2 bars later in the form of a 2-bar reversal, and the short entry was below the lower of the 2 bars. That entry below that bear trend bar was also a break below a micro double bottom formed by that bear bar and the doji bar 2 bars earlier. Figure 6.16. Signal bars, other types. 145. Bar 5 was a filed upside breakout above an E. Bar 6 was a bull reversal bar and a second attempt to rally on a test of the low of the day. Bar 7 was a doji, but it was a pullback to the moving average with a bull body after a strong move up, and it was the second attempt to rally. The first was the bar before it. Bar 8 was a bear inside bar, but it followed 3 strong bull trend bars. With that much upward momentum, it is better to wait for ace condon try before shorting. Bar 8 was a 2-bar reversal and in the middle of a 2-bar reversal on a higher time frame chart. The bull component of that higher time frame reversal was formed by the 3 bull trend bars before bar 8, and the bear component was the series of bear trend bars that ended at bar 11. Some higher time frame charts would assure all of those bars, and others would use most of the trades that took place during those bars. Bar 9 was a bull reversal bar, but it was relatively small compared to recent bars and therefore less likely to lead to a successful long. It was better to wait for a second entry, but one never came. Instead, the longs who bought above bar 9 were immediately trapped as the market reversed into an outside down bar. Selling below the bar 9 low was acceptable because it would be capitalizing on those longs who would have to sell out of their now losing positions. However, a trader would have to think quickly to realize this and place an order. Bar 11 was an EOI and a second entry long setup on the push below the bar 7 swing low. On trading range days, the market often reverses breakouts above and below prior swing points, and second signals are especially reliable. The first signal was 2 bars earlier, but the downward momentum at that point was so strong that it would have been unwise to buy there. Bar 13 was a risky long entry because whenever there are 3 or more overlapping, relatively large bars sitting on the moving average, the bull breakout is usually a trap. Deeper discussion of this chart. 1 Thea Pennant figure 6.16, the market continued the rally from yesterday's close, pulling back to the moving average and setting up a moving average pullback short. However, the upward momentum was strong, so it was better not to take the first entry short and instead to wait to see if there would be a second. The market fell below the open of the day, and the breakout to the new low failed. This reversal up was a possible low of the day, and it formed a double bottom with the first bar of the day and a higher low. Bar 1 was a failed low 2-buy setup with the low before yesterday's close being the first push down. Bar 2 was a strong follow-through bar for the long entry above bar 1, and it became a large breakout bar after the failed low 2. A failed low 2 usually is followed by either 1 more push up and a wedge bear flag short setup, or 2 more pushes up and a low 4. 146. Price action. Figure 6.16. If the breakout is strong, as it was here, the low 4 is more likely. Since it was such a strong spike up, a channel up was also likely. The channel assumed the shape of a wedge. Once either a wedge or a channel reverses, the first target is a test of the start of the pattern. Bar 3 was the expected low 4 short setup after the failed low 2. It was also the setup for a reversal down from 2 wedge tops. The smaller one had the bar after bar 2 as the first push, and the second push up occurred 3 bars later. The larger wedge began with the second bar of the day and the second push was the bar after bar 2. Both wedges should be followed by at least 2 legs sideways to down and they should test the start of each wedge. The test of the start of the smaller wedge occurred 3 bars after bar 3. It had 2 small legs, with the tail of the doji that formed 2 bars after bar 3 being the first leg down. The bar bounced up into its close and the second push down came on the next bar. This was a double bottom bull flag with the swing low that formed 3 bars after bar 2, and this is a common setup when the market tests the bottom of a channel or wedge. These 2 small legs were just the first leg down for the larger wedge top, and bar 6 was the end of the second leg and the reversal up from the test of the bottom of that wedge and a 5-tick failed breakout. Bar 5 was the third small sideways bar after a sell-off, and any sideways pattern after a move can become a final flag, as it did here. Because it did so with a 5-tick failure, there were trapped bears who bought back their shorts above bar 6, adding to the buying pressure. Bar 6 also formed a double bottom bull flag with the low of bar 1, leading to the expected bounce. It also was the setup for the long from the wedge bull F flag that had its first push down 3 bars after bar 3 and its second push down 3 bars before bar 5. Bar 7 was a wedge bull flag in a strong up move. The first push down was the bar just before 10 a.m. Pacific Standard Time, and the second push down ended 2 bars before bar 7. Even though dojis in general are not reliable signal bars, they can be for pullbacks in trends or in strong legs in trading ranges. Bar 8 was an inside bear trend bar that was the end of the second leg up in a trading range day and a test of the high of the day, both of which often lead to a reversal. It also followed a trend channel line breakout, and the third push up in a bull channel. Bar 5 was the first. Bar 11 was technically a high 3, but should be expected to behave like a high 2, since the bar 10 outside bar bull trap should be considered the start of the downswing, not the bar 8 actual swing high. Figure 6.17. Signal bars, other types. 147. Figure 6.17. A bear reversal bar can lead to a bull flag. A reversal bar in a bull trend is not enough reason to go short, and it sometimes becomes a bull flag. In figure 6.17, the bar after bar 1 was a strong bear reversal bar, but it followed 5 strong bull trend bars. In the absence of no prior strength by the bears, it was not a short setup. Only a second entry could have been considered, which was a short below bar 2. However, a bar in a bull trend is not enough reason to go short, and it sometimes becomes a bull flag. In figure 6.17, the bar after bar 1 was a strong bear reversal bar, but it followed 5 strong bull trend bars. In the absence of no prior strength by the bears, it was not a short setup. Only a second entry could have been considered, which was a short below bar 2. However, bar 2 was a doji and there were 4 largely overlapping bars in a strong bull trend. Rather than short, it was better to wait for a pullback to buy. The 2-bar reversal at the moving average 4 bars later was a good setup. Although buying above a bear trend bar in a bull spike is often a good trade, buying above the bear trend bar here or above the bull reversal bar that followed it was risky. Bar 1 was a large bull trend bar after several other bull trend bars, and it was therefore climactic. There was too much risk of a sideways to down correction after a buy climax. If you look at the highs of the bars up to bar 1, the slope was increasing. This parabolic curvature is also a sign of climactic behavior, and that makes the risk of a correction significant. Buying a pullback or looking for a short was a safer approach. Bar 4 was a 2-bar reversal following a breakout below 2 small doji bars, and the bar 3 breakout below a 7-bar horizontal bear flag near the moving average. Because the trend down for the past 15 bars or so had only very small pullbacks, this was a scalp long at best, despite the large outside up bull trend bar. 148. Price action. Figure 6.17. Bar 5 was a small bull reversal bar with a close near its high, and it was the third push down in the past 6 bars, so buyers were starting to come in. Although the market was still in the bear channel of the past couple of hours, this is a good long scalp setup. Bar 6 was a large bear trend bar with a big bottom tail and a close above the midpoint of the bar, which can be enough of a show of strength by bulls to reverse the market, especially after a collapse at the end of the bear trend. It was also an overshoot of several bear trend channel lines not shown. With 4 large bear trend bars in a row, only a second entry long can be considered, which came on the bar 7 outside up bar. The bar 7 low was a small higher low, which is the start of the second leg up. It is acceptable to buy above bar 6, but better to buy above the high of a bull bar, like the bar after bar 6, and best to buy at a second signal. Bar 7 was that second signal, and you could buy either as soon as it went outside up, because it went above the high of that strong bull bar that followed bar 6, or above the high of bar 7. Deeper discussion of this chart. In Figure 6.17, the market opened with a gap up and a bull trend bar, creating a bull spike, and then pulled back a little on the second bar, trading as low as below the middle of the first bar. This was the only pullback before the market went parabolic, creating a gap spike and channel bull trend and a trend from the open bull trend. Parabolic means that the trend accelerated after already being strong. Here, If you draw a trend channel line across the highs of the first 3 bars, highlighting the slope of the trend, you will see that the 4th bar broke above that trend channel line. If you continue to draw trend channel lines across the highs of successive bars, you will see that the lines get steeper and then flatter at the high. This is a parabolic shape, and a parabolic move is a type of buy climax. Since the market was still in a trend from the open bull trend, you should not sell the first attempt at a pullback, because the first pullback is almost always followed by a test of the high within a few bars. As strong as the upward momentum was, traders should always be aware that the market can reverse at any time, especially in the first hour. The market often races to some magnet that often is not evident, and once it is tested, the market is then free to do anything, including reverse. Whenever there is any type of climax, once the market begins to correct, it usually corrects in 2 legs and for at least 10 bars. Just before bar 3, there was a 7-bar horizontal bear flag, and tight trading ranges after a trend has gone for 10 or more bars often become final flags. There was a low 2 short signal with a bear signal bar, but because of the possibility of a final flag reversal, it is better to only scalp the short. The breakout of the bear flag was the large bar 3 bear trend bar, which is always a spike in a sell climax. When a sell climax forms after a figure 6.17, signal bars, other types. 149. Protracted trend, it can fail and lead to a 2-legged sideways to up correction lasting about 10 bars. However, there has been no significant sign of strength in the bear trend, so if the market does try to reverse, it is better to look only for a scalp. The spike was followed by a wedge bear flag that was formed by the doji after bar 3, the outside up bar after bar 4, and the small doji 2 bars later. It can also be viewed as a low 2 short, with bar 4 being the first push down and the short being below the small bull inside bar 4 bars later. The move consisting of 4 strong bear trend bars down to bar 6 was another spike and therefore another sell climax, and it was the 3rd push down after the bar 3 spike. Channels that follow spikes often end with 3 pushes, but when the downward momentum is so strong, it is better to wait for a second signal before looking to buy, and this occurred with bar 7. A bear channel is a bull flag, so the market should rally once it breaks above the bear channel. Also, it should test the start of the channel after the bar 3 spike down, but sometimes the rally will not be completed until the next day. 150. Price action. Figure 6.18. Figure 6.18 weak reversal bars need more. When a reversal bar is not particularly strong, it can still be a good setup if there is an additional reason to take the trade. In figure 6.18, bar 1 was a relatively small bar after a big bear trend bar broke out of a large flag, and might have been setting up a failed breakout of the flag. It was also an exact test of the earlier low. On a trading range day with bar 1 setting up these 2 reversals, it was a reasonable long setup, especially since the next bar created a 2-bar reversal buy setup. The rally up from bar 1 and the sell-off down to the same price area the next day formed a 2-bar reversal top on some higher time frame chart, and a single reversal bar on an even higher time frame chart. Bar 2 was a small bear reversal bar after a large bull trend bar that broke out of a small trading range. This was an acceptable failed breakout short signal bar. Deeper discussion of this chart. The market broke out above yesterday's high in figure 6.18, but the breakout failed and led to a trend from the open bear day. Figure 6.18. Signal bars, other types. 151. Bar 2 was a final flag sell setup after the failed breakout from a tight trading range. Tight trading ranges after 10 or more bars of a swing often become final flags. It also was a double top bear flag with the 7:30 a.m. Pacific Standard Time high. Remember, close is close enough. The bear trend that followed was huge and the market closed 30 points lower, but the rest of the day is not shown because it would shrink this bull trend bar to the point of looking unremarkable instead of how it appeared in real time. 152. Sand bottoms are not always a sign of strength. When many shape tops and bottoms occur close together, traders should be very careful because they may represent low volume in a trading range instead of strength in a trend. In the first cluster of 4 shaved tops in figure 6.19 indicated by S, the bear trend was still strong. However, in the second cluster, the market was in a trading range and they may just indicate that the volume was low. Be very careful about trading under these circumstances. Deeper discussion of this chart. The market broke out above yesterday's high with a gap up in figure 6.19, but the first bar was a bear trend bar and therefore a sign of weakness by the bulls. The market could have traded down in a failed breakout but instead broke to the upside with a strong bull trend bar. This could have led to a strong trend from the open bull day but instead was followed by a large bear trend bar. This set up a 2-bar reversal for a failed breakout short, but the short was never triggered and the longs were still holding their positions. The market then broke to the upside out of the E pattern, however, the breakout failed, setting up a failed breakout short and a possible high of the day. Figure 6.19. Signal bars, other types. 153. When there are several bars with large ranges that form a tight sideways trading range, entering on a breakout is risky because most breakouts will fail due to the magnetic effect of a tight trading range. The market broke out to the upside and then to the downside, and then rallied off the moving average back into the range. The spike down to the moving average was followed by a lower pullback that formed a lower high and then it evolved into a double top bear flag. The pullback to test the high of the day had low momentum, indicated by many overlapping bars, several bear bars, and many bars with tails. That is not how a strong bull leg looks. CHAP